In this video, we're going to look at CAE. This is a Canadian aerospace company. And what I do in my videos is I try to figure out the actual stock price for a company and then look at the financial ratios and compare them to its competitors. So let's get started with the model. So this company has a market cap of $5.24 billion. That's Canadian dollars. And that's the value of the company according to the stock market. And they're trading at 19.80. So that's one share of stock is $19.80. Next, I'm going to pull the free cash flows. And free cash flows is the cash that's left over after paying your operating expenses and also your capital expenditures. Capital expenditures are large expenses like airplanes and buildings. Now I'm going to pull the net income, which is the profit and loss for the business. And that's on the income statement. And then I'm going to pull the revenue, which are the sales for the business. And I'll put all that into the model. And the model is going to do all the calculations. And you can see the numbers are pretty consistent, so we should get a good value for this company. Let's look at a capital structure of the business so we know what discount rate to apply to the future cash flows. So they pay $125 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to liability section. And current debt is $94 million. That's debt due within 1 year. And long-term debt of $3.8 billion. That's debt due after 1 year. Since interest payments are tax deductible, let's get their effective tax rate. They have $400 million of income before tax, and they pay $74 million in taxes, so their effective tax rate is 19%. The cost of debt is 2.6%. Let's get the cost of equity. We need the beta. The beta is how much the stock moves relative to the entire market. So if it's a beta of 1, that means the stock moves with the market. This has a beta of about 2, so the stock moves twice as much as the market. So if the market goes up 10% over the course of 1 year, this stock should go up 20%. And if the market went down 10%, this stock should go down 20%. Let's go back to the balance sheet because we need some more information for when we look at the ratios later. Let's get their current assets. These are mainly cash, accounts receivables, and inventory. And that's $2.8 billion. And let's get their current liabilities. These are debts and payables, which are due within 12 months. That's $2 billion. We also need their equity. That's assets minus liabilities. That's $2.5 billion. And our EBIT is earnings before interest and taxes. On the income statement, that's called operating income. That's $500 million. That's how much money the company makes from its operational business, but before it pays interest on its debt and before it pays taxes. So let's look at a capital structure. The cost of debt is 2.6%, and they have 61% of debt in the capital structure. The cost of equity is 17.4%, and they have 40% of equity in a capital structure. And so the weighted average cost of capital is a blend of the cost of debt and the cost of equity, which is 8.3%. And that's what we're going to discount the future cash flows by. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $5 billion. We divide that by 265 million shares. And we get an intrinsic stock price at $19.94. They're trading at $19.80. So they're trading at a 1% discount. It's a buy according to the model, but it's really close. It's amazing how close my calculation is. So I'm saying the stock is actually worth $19.94 and it's trading almost exactly at that price. Let's see what Simply Wall Street says. They're saying the stock is worth pretty much what it's trading at as well. So we're both in the same ballpark. Not many stocks trade at intrinsic value. This stock does. And it looks like it was trading at a premium for a while. Let's look at the financial ratios of the company. So they have a decent PE of 16.8. That's price to stock over earnings per share. They have a really good price to sales ratio of 1.4. That's price to stock over sales per share. They also have a good price to book of 2.1. That's price of stock over book value per share. They're in good shape in current ratio, 1.4, so they can cover their current liabilities. The ROE is 13%. That's a little low. That's net income over equity. They're doing good in interest coverage. They can cover their interest expense 4 times. And they're a little high in debt at 61%. So the best ways to look at ratios is to compare them with similar companies. So I've done videos on Boeing, Airbus, FTG, another Canadian company, General Dynamics, Raytheon, and Spirit. They're all in the same industry as CAE. So if CAE has a number in green, they're better than the average. If it's in red, they're worse than the average. So they have more red than green, which is not good. But CAE has a 16.8 PE ratio, which is better than the average. The average is negative just because Boeing has a negative, and that drags down the average. FTG is the best at 5.9. FTG is also the best in price to sales and price to book. CAE is worse than the average in price to sales, price to book, current ratio, and ROA. So even though they have good ratios, you have to compare them against the average in the industry, because that's how you really know. And their debt is a little worse than average. Average is 57%. They're at 61%. FTG is best at 15%. Boeing is 100% debt. And the market cap, they're worse than the average. This is in Canadian dollars, and so is FTG. The rest are in US dollars. So let me know what you think of the video. Thanks for watching.